This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Mike's picture saying looking for the downloads. Now, Nick, I want to start off here by just having a quick look at the crude oil chart. And we once again had a negative spill on the downside. It rejected the 50-day moving average and just broke to a fresh new low, not holding the $72 level. And we find ourselves here in quite a short-term oversold state, trading right into the 2023 lows. Now, that doesn't mean that it can't break to a lower low or even go to like $65 or $60. But usually, technically, when you approach a major support line, it offers a reaction along there. And so one of the things from that I'm looking for here in the $68, $69 level is whether a very typical reactionary bounce happens, sending us back towards $72 to $74. That wouldn't necessarily be bullish beyond just a bounce. There's going to be a lot of work for the oil bulls to turn this around. It could be a prolonged basing formation that could go deep towards the elections before the bulls have the technical structure to put together something bullish on the upside. So moving on to page 3, we have that S&P 500. Nick, let's just start off with your levels.
Yeah, Patrick. So right now on SPX, we have a spot price of approximately 55.20. And we have an implied move that actually increased from last week from 140 points to 160 points for the September 20th monthly OPEX. So we have an upper implied move, therefore, of 56.80 and a lower implied move of 53.60. Right now, we have key resistance at all-time highs at 56.70 and key support at 5,500. Right now, I'm inclined to think we see some more up and down action, kind of like a kangaroo market overall for the next few weeks. And one thing to keep in mind, too, is that we've already declined by about 2% for September so far. The average decline over the last 10 years in September is 2.3%. So I'm not so sure we get that much more downside in the short term, though a lot of people expect that. I'm more inclined to think we see a bounce between the 5,400 area and the 5,600 area for the next few weeks.
Well, it's interesting because we're trading right at the 50-day moving average. Now, the reaction down was on the ISM manufacturing numbers that came out on Thursday. And we continued to see things like the JOLTS and ADP jobs numbers coming in weak. And that certainly has contributed to this coming off. I think really this is going to be all decided on Friday when we get that jobs numbers. Because if it comes out negative because bad news is bad news, we could spill down to 5,400 on the S&P futures on a quick move. I'm not so sure that the market is going to have the floodgate open before the FOMC meeting. And so even if we did have a spill down there, the 5,400 area is very close to the 50% retracement of the prior rise. So it would be a very logical place for any short-term weakness to find that short-term support. There is lots of opportunity during technical topping formations for the market to have numerous fakeouts. To your point of there being numerous false starts and like a ping pong match between support resistance, it's entirely possible that we even pop up towards the 5,700 highs after a negative reaction, creating maximum confusion for many traders. And it'll certainly be possible for things to play out that way. The interesting part going into the second half of September is that many of the share buybacks get frozen going into the earnings season of October. And so that certainly will influence some of the flows, and the particularly weakest parts of September are the last 2 weeks of September. And it's interesting that falls right after the FOMC meeting. Now, usually when something is so well advertised, like an event that the market is weak in those 2 weeks, rarely does the market deliver on expectation. So there's certainly lots of confusion going to be going in here. The bigger question is, does the market start some sort of big trend move prior to the elections? Or just like you were suggesting, are we going to have far more fake out moves and grind out towards the US elections? Right now, anyway, 5,400 is my lower support line. And I don't necessarily think any sustained rally above up to 5,700 will hold either. So that's my tight range. Now, moving on to the Nasdaq on page 4. Nick, what are your levels here?
So right now, spot price on Qs is approximately 458, and we have an implied move of plus minus 18 points for the September monthly OPEX. Therefore, the upper implied move is 476, and the lower implied move is 440. Right now, we have key resistance at 485 and key support at 450. Now, post NVIDIA's earnings last week, we saw them decline over the last few sessions, and that's brought down the entire tech sector overall. However, there are some deals to be had, in my opinion. Namely, Google is one I'm looking at with a forward price earnings ratio of about 18 or so. And overall, I'm inclined to think that we see the market kind of chop over the next few weeks. So I'm going to be waiting this out and watching from the sidelines with more long-term view on names that I want to buy on dips.
Yeah, it's interesting. The Nasdaq continues to underperform and continue to do worse than the other indices. So, example, this morning we are down 0.5 point on the Nasdaq while the Russell's flat. This we continue to see this trend where the selling is targeted toward that tech sector. When you look at those Mag 7s, whether or not you want to look at the valuations, bottom line is beyond Apple's bounce higher, most of the Mag 7 stocks actually have very weak charts that are trading below their 50-day moving averages and have been on balance distributed. It's certainly been the trend for the last few weeks, and it'll be interesting to see whether or not that trend continues as we move forward. So, Nick, I wanted to move on to page 5 here, where we have the volatility index, the VIX trading up in the 20 handle. What are the implied ranges for you here?
So right now with the VIX at a 20 handle, we can expect to see intraday top to bottom ranges on SPX of approximately 1.25%. And important to note that with the election coming up soon, it's probable we see elevated volatility into that time period. So insurance is more expensive now than it was last week, for example, by a factor of about 25% or so. However, if your portfolio does correlate heavily to S&P, it makes sense to perhaps take some hedges in the form of perhaps callers into the election event, as that may be a volatile time period overall. And moving on to that page 6 dollar index, we have the chart here, which is showing us trading near the 2023 lows. What are you thinking here?
So when we're taking a look at that US dollar index, it has been actively distributed. Lower highs, lower lows, persistently below all of its key moving averages. But it's at that major support line you highlighted. But the question is that a support line that can hold? We have to dissect this by looking at some of the individual currency crosses. Particularly the one currency that's been driving this has been the yen. That US dollar yen collapsed from the 162 level, hitting 142 back in August. And we're finding ourselves trading right back toward that low. The December 2023 low was near 140. And so we're a stone throw away from some key support lines being tested that could offer a short-term reaction in the dollar in that very important currency cross. When we look at that euro, it traded right to major overhead resistance from 2023, trading in that kind of 111 to 112.5 area where all those highs came in. And so there's a lot of, even though the trend has been very pronounced to the downside, we have some key technical resistance and supports that are coming in that could offer a reaction. With a lot of major economic catalysts and FOMC rate cuts scheduled for September, it'll be interesting to see whether or not the dollar establishes a short-term low and a potential trend shift.
Now, Patrick, moving on to page 7, we have that gold futures chart, which is making new all-time highs. I think we're going to see it perhaps pushed near 3,000 in the near term. What are your thoughts here?
Well, it has been behaving very well. Like you look at even just something like silver, which is the cousin of gold, the pullbacks have been deeper and more pronounced. Gold, even during these pullbacks, seems to be bought on dip almost instantaneously and trades right back to the highs. It exhibits all the characteristics of healthy accumulation. The trend has been primarily up, even a pullback down towards 2450, which would be a very typical technical event, didn't yet develop. And so if this manages to break to a higher high, there's a technical measure moves that are measuring up to the 2700 area, which would be a very logical short to intermediate target on the upside and would be a real clear indication of a continuation of this bull trend that has been quite intact in spite of a lot of carnage in the entire commodity complex. Now, Nick, on page 8, I have that copper chart. The downtrend and the sell-off has been relentless over the last 3-4 months. And now we had a bounce over the last few weeks that saw us test the 50-day moving average and approach a 50% retracement of its prior decline. And yet we roll over here. At this juncture, the primary downtrend is still intact. Now, while I think that we're much closer to the bottom of copper and don't think that there's a huge downside, there's also no technical evidence that the bulls have come back in play here and that a new bull trend is imminently about to resume. I think there's lots of vulnerability in this challenging few months for, let's say, copper to take a couple of stabs below $4, retest those 2023 levels where it spent a lot of time in that $3.75 to $4 range. And that's where a lot of the bottoms come in for what will inevitably be a very bullish setup, probably sometime in October or November. Right now, in the short term, I think that this consolidation is still the path of least resistance, and we're going to have to see where the bottoming formations develop.
Now on page 9, we have that uranium chart, which has been hovering between that 23 and 25 area for the past month or so. What are you thinking here?
So far, uranium has rejected its moving averages and has failed to break the downtrend. But we are seeing finally the price action behave in a divergent manner. And if we see that uranium stops making lower lows here and establishes a base, this could be the price levels from which a potential technical bull breakout could happen. What I'd be looking for on the Sprott Physical Uranium Trust chart would be a decisive breakout above the $25 level, breaking that descending channel and potentially demonstrating that some sort of new accumulation cycle may have begun. It is a little early to be making that kind of a call, but it's certainly now a level where it could happen. And so it's high on my watch list to see whether or not it develops a breakout. Finally, on page 10, I wanted to look at the 10-year yield, and we find ourselves after the weak ISM numbers and the weak jobs numbers that have been rolling in, that the yield is now down below some of the August levels and actually very close to its one-year low. The big question, of course, is this a level that will be broken on the downside in the post-jobs numbers on Friday? And this is a line in the sand. If there was going to be a catalyst for yields to rise on some sort of a strong jobs numbers, it certainly would happen tomorrow. And so I think this is a very key technical level. If we see the jobs numbers come in weak and this remains below 380, the downside window's open to 350 basis points very easily. For those of you that enjoy these chart decks and the conversations, you get them every single day at Big Picture Trading.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.